Let's be honest, it's the question in finance, isn't it? It's the one every single investor, from the Wall Street pro to you, maybe just downloading your first trading app, asks themselves. Can I be the one? Can I actually outsmart everyone and beat the market?
I mean, think about it. There is a literal army of the world's smartest people, PhDs in math, physics, you name it, and they have billions of dollars in technology all dedicated to finding some tiny, hidden edge. The sheer brainpower is staggering. But what if the game itself is rigged? What if it's designed from the ground up to be unbeatable? To really get to the bottom of that, we have to talk about one of the most powerful and, frankly, most controversial ideas in all of economics. It's called the efficient market hypothesis.
Okay, so what is this thing? Well, at its heart, the EMH is actually pretty simple. It says that any piece of information that could possibly affect a stock's price, an earnings report, a big announcement, a lawsuit, it gets absorbed and reflected in the price almost instantly. So, by the time you read about it in the news, it's already too late. The information is, as they say, priced in.
Now, this isn't an all-or-nothing idea. It kind of comes in three different flavors. The weak form just says you can't get an edge by looking at old price charts. Then there's the semi-strong form, and this is where most of the debate happens, which says that even if you dig through every public report and news article, you still won't find an edge. And the strong form? That one goes all the way, claiming even secret insider info is already priced in, which, yeah, most people agree is probably not true.
And this table really shows you why that matters. See, if the market is just weak form efficient, then all that technical analysis, drawing lines on charts, is basically useless. If it's semi-strong, then even fundamental analysis, the stuff Warren Buffett is famous for, is a waste of your time. The point is, the more efficient the market is, the fewer tools you have left in your toolbox.
Okay, so that's the theory. It sounds elegant, it's logical, but does it actually hold up in the real world? Well, to find out, we don't have to argue about abstract ideas. We can just look at the scoreboard. Let's see how the professionals, the folks who get paid the big bucks to beat the market, are actually doing.
Before we even look at the numbers, a Nobel Prize winner named William Sharpe laid out the brutal truth with just simple math. Think about it. If you take all the active investors and all the passive investors together, well, they are the market. So before you account for fees, their average return has to be the market's return. But active managers have way higher costs, research, salaries, constant trading. So once you subtract those fees, the average active manager must, by definition, do worse than the average passive investor. It's just simple arithmetic.
And here is that math in the wild. 88.68%. Just let that number sink in for a second. What is it? That's the percentage of large-cap fund managers who utterly failed, to beat their own benchmark over a 15-year period.
And this isn't some cherry-picked stat. This is the latest data, and it is absolutely brutal across the board. Look at the large-cap growth funds. These are the guys trying to find the next Google or Amazon. Over 15 years, nearly 96% of them couldn't even keep up with the market. It doesn't matter where you look, the story is the same. The pros are losing. Badly.
Okay, you might say. But what about the few who do win? Can't I just find a fund that did great last year and invest in that? Well, nope. The data shows that success is basically random. Of all the funds that were in the top 25% in 2020, not a single one managed to stay there for the next 2 years. That pretty much screams that any outperformance is way more about luck than it is about skill.
All right, the evidence is just crushing. The theory holds up. The market is unbeatable. Case closed, right? We can all go home? Well, not so fast. Because if the market is really this perfect, rational machine, how do you explain things like bubbles or market crashes? This is where we start to see the cracks in that perfect machine.
The crack is us. It's humans. We aren't logical robots. We're just these bundles of emotional biases. We're wildly overconfident. We follow the herd, buying high when everyone's excited and selling low when everyone's panicking. And we absolutely hate losing. So much so that we hang on to our losing stocks forever, but we sell our winners way too early. These aren't just random mistakes. They're predictable patterns of irrationality.
And here's the real logical checkmate to the idea of a perfectly efficient market. It's a paradox. Just think about it for a second. If prices already reflect all the information out there, why would anyone bother to spend money on research? There's no reward. But if nobody does any research, how does the information get into the prices in the first place? It can't. So for the market to work at all, it has to be at least a little bit inefficient.
So, that logical crack, it opens a door.
It suggests that exceptions to the rule might be possible, and there is one exception that is so powerful, so secretive, and so unbelievably successful that it might just be the single greatest argument against the whole theory.
It's a hedge fund run by a firm you've probably never heard of, called Renaissance Technologies. You can invest in it. Its employees are sworn to secrecy. It's the stuff of Wall Street legend. Its name is the Medallion Fund. 62%. Let me say that again. 62%. That is Medallion's average annual return before their massive fees every year since 1988. I mean, that number is so high, so consistent, it's considered a statistical impossibility. They aren't just beating the market, they are completely rewriting the rules of the game. So how on earth do they do it? Well, it's not what you think. They don't hire Wall Street MBAs, they hire code breakers, astronomers, and physicists. They're not trying to find the next Apple. Instead, their supercomputers hunt for these tiny, fleeting ghost patterns in just mountains of historical data. And here's the craziest part. Their trades are only right about 50.75% of the time. That's barely better than a coin flip. But by making hundreds of thousands of those tiny bets every single day with huge amounts of leverage, they turn that microscopic edge into an absolute fortune.
Medallion was really the canary in the coal mine. They proved that this kind of quantitative, data-first approach could work on a massive scale. And today, that approach isn't the exception anymore. It's the rule. We are now fully in the era of the machines.
So what is it? Is the market efficient, or is it driven by our flawed human brains? Well, a newer theory called the adaptive market hypothesis says, why not both? It argues we should stop thinking of the market as a physics problem and start thinking of it like a biological ecosystem. In this ecosystem, different strategies are like different species, all competing, adapting, and trying to survive. Market efficiency isn't some fixed state, it's constantly changing.
And in today's market ecosystem, there is a brand new apex predator. I mean, just look at this. Up to 70% of all the trading happening right now comes from algorithms. The humans? Well, we're becoming the minority species, out-hustled and outsmarted by the raw speed of the machines. And the gap between human and machine, it's not a gap, it's a canyon. An AI can fire off 500,000 trades in a single second, looking at data points we can't even comprehend. The best human investors are thinking in terms of months or years. Algorithms are thinking in microseconds. It's not even the same sport anymore.
Okay, let's pull all this together. We've got this powerful theory of an unbeatable market. We've got the brutal data that mostly backs it up. We have our own irrational brains creating cracks in the system, and now we have super-intelligent machines exploiting those cracks. So what does that all mean for you? What's your winning move in this crazy, complex game? Here's the verdict. Yes, beating the market is technically possible. The Medallion Fund is living proof. But, and this is a huge but, it requires an edge that is so technologically advanced, so expensive, so secretive that for pretty much everyone else on the planet, the market might as well be perfectly efficient. For most of us, trying to outsmart this system is a fool's errand. The real winning move isn't trying to beat the market, it's to simply own the market through cheap index funds and let its power work for you over the long run.
And that leaves us with this one last, kind of mind-bending question for the future. As these incredibly powerful AIs take over more and more of the market, are they finally going to iron out all our human biases and create that perfectly efficient machine from the textbooks? Or are they all just going to create a new, much faster, and way more dangerous version of herding? Is the market's future becoming more predictable or more chaotic than ever before?